In this video, we're going to discuss insurance accounting and financial statements. This topic, insurance accounting, is not covered in the CPCU 520 text. Much of what we discuss in this PowerPoint is actually covered in CPCU 540, which is Finance and Accounting for Insurance Professionals. But I consider this so important to insurance operations and an important aspect of what you need to know before we get to surplus lines and reinsurance that I want to spend time on it in this video. For the insurance accounting portion of this exam, you will only be responsible for this PowerPoint, this video, and the insurance accounting problems. I'll go over the insurance accounting problems in separate videos. So let's begin with a discussion of why statutory insurance accounting principles exist. Consider the fact that all other insurance regulatory objectives are meaningless if an insurance company's solvency is not maintained. If an insurance company cannot pay claims because they don't have enough money, whether it's because they've overestimated their assets or because they've underestimated their liabilities, then it doesn't matter if they've been exercising good market conduct. Solvency is absolutely critical to the ongoing operations of an insurance company. And monitoring occurs primarily through financial reporting requirements using uniform statutory accounting principles. Let's compare generally accepted accounting principles and statutory accounting principles. There are many differences between the two, but this is a summary of the comparison. Also, before I begin, don't confuse statutory accounting principles for insurance companies with tax statutory accounting principles. Accountants, especially tax accountants, will often refer to tax accounting principles as statutory accounting. For our purposes, though, when we say statutory accounting, we're referring to insurance statutory accounting. GAAP accounting assumes that revenue should be recognized or timed to match the timing of expenses. If you incur certain expenses before your product is sold, you don't have to recognize those expenses until that product is sold. For example, if you incur sales expenses or expenses for supply, those expenses don't have to be recognized until you earn the revenues associated with those items. Additionally, under GAAP accounting, the entity is considered a going concern. This means that at a given point, things like furniture and equipment, if you had to sell these items, you would have time to sell them. Conversely, under statutory accounting, the assumption is that expenses must be recognized immediately when they are incurred. We've talked about this a bit before. Things like commissions and other costs of underwriting must be recognized right away, but revenue cannot be recognized until the premium, which is the primary source of revenue for an insurance company, is earned. And premium, as we've discussed, is earned over the policy period. Secondly, the entity is viewed on a liquidated basis. Because of this, some assets are non-admitted. We'll look at that more in a minute. But the idea is that if at some point the insurance company is viewed as insolvent, they would not be able to sell off their assets at their market value. In fact, things like furniture would basically have no value at all. Statutory accounting principles also have what are called Schedule F and Schedule P penalties. Remember, we've discussed Schedule F is the reinsurance schedule. The Schedule F penalty is a penalty for using unauthorized reinsurance. Basically, an insurer can't recognize the relief they get from using unauthorized reinsurance. Schedule P is the loss schedule. Schedule P penalties are a penalty for under-reserving in certain lines of business. Those penalties are set by the state. Let's continue to compare GAAP versus statutory accounting. Under GAAP accounting, there are such things as deferred acquisition costs, but these cannot be recognized under statutory accounting. Those again are the costs that you incur before you actually sell your product, but under GAAP accounting don't have to be recognized until the revenue on that product is earned. Deferred acquisitions costs don't exist at all under statutory accounting principles because expenses must always be immediately recognized. These include agents' commissions, underwriting, taxes, overhead. Because of this, an insurance company that is actually growing can look like it's losing money over time. We looked at this before, but this will become even more clear as you go through the insurance accounting exercises. Next, non-admitted assets. Furniture, fixtures, leasehold improvements, and certain equipment cannot be recognized under statutory accounting principles. Again, this is the concept that an insurance company is not viewed as a going concern, that at any point in time, the company must be viewed on a liquidated basis. In other words, what would the value of the company be today if all of its assets had to be immediately sold and turned into cash? Another example of a non-admitted asset are premium balances or agents' balances that are more than 90 days overdue. These are premium dollars that the agent has collected from policyholders but has not remitted to the insurance company in more than 90 days. And last, reinsurance recoverables that are more than 90 days overdue are also non-admitted assets. Now let's look at the general layout of an insurance company's balance sheet. We'll focus on the most significant and important accounts in the balance sheet. First, the asset side. Generally speaking, the largest asset of most insurance companies are bonds. This is because bonds tend to be less risky than most stocks. But insurance companies also carry a significant amount of stocks. Insurance companies also hold a significant amount of real estate, sometimes in the form of real estate investment trusts. Remember that for an insurance company, most of their assets are tied up in investments like stocks and bonds. Additionally, note that many bonds for an insurance company are government bonds, such as municipal bonds and treasury securities. Again, this is because these are fairly low risk. This goes along with the view that an insurance company should be viewed on a liquidated basis. Next, cash and premium balances, which are those premiums that an insurance company's agents are holding on to at a given point, and reinsurance recoverables, which is the amount of money owed to the insurance company from a reinsurance company because of a loss that was reinsured by the reinsurance company. Then the liability side, loss reserves. This is the amount of liability that is set aside by an insurance company for losses that have occurred but have either not been reported or been paid but not been paid enough. Similarly, loss adjustment expense reserves for losses that have occurred but have not been completely settled, and unearned premiums. This might also be the largest liability for an insurance company. These are premiums that have been written. In other words, the policy has been issued and bound, but the time on the policy has not expired. And those are the primary liabilities of an insurance company. And also on the liability side is also, of course, equity. For insurance companies, this is known as surplus as regards policyholders. Now let's look at the principal elements of an insurance company's income statement. Earned premium is basically the revenue for an insurance company, at least in terms of the underwriting side. And their major expense is losses incurred, which includes both paid losses and loss reserves, and their loss adjustment expenses and other underwriting expenses. That is their net underwriting gain or loss. Remember, though, that an insurance company depends heavily on their investment income from their investment operations. And there's also typically a category for other income, which could be selling off other assets, such as real estate, and any net realized capital gains or losses. And that is their net income before dividends or taxes. Many times, insurance companies don't pay corporate income taxes because they pay a significant insurance premium tax. Let's break down the income statement a bit further. We've actually discussed this before, where earned premiums is the beginning of year unearned premium plus the net written premium minus the end of year unearned premium. And this is because the beginning of year unearned premium must be earned over that year. The net written premium account for whatever new policies were written during that year, but we subtract off any end of the year unearned premiums. Remember that this is the calendar year method of calculating earned premiums. We've also discussed how to calculate incurred losses. This is losses paid plus the end-of-year loss reserves minus the beginning-of-year loss reserves. Again, remember that we add in end-of-year loss reserves because those were set up for losses that either occurred during that year or in a prior year. And we subtract beginning-of-year loss reserves because those were for losses that occurred in a prior year. And of course, there's also loss adjustment expenses and other underwriting expenses, as well as some investment expenses. We've discussed before how an insurer earns insurance premium, and the reason for this is because of statutory accounting. First, how they earn premium depends on the period of the policy, but for the purposes of this course, we will always assume a one-year policy. The vast majority of policies are one-year policies, but some are 3 or even 5 years. So let's look at an example and assume the following. An annual one-year policy written on January 1st, 2015, and a $365 premium. On January 2nd, then, the insurer has earned $1 of premium. On July 1st, the insurer earned approximately $182.50, which is 50% of $365, or half of the premium. By midnight of December 31st, 2015, the insurer earns the entire $365. That concludes our discussion of financial insurance accounting. I will add separate videos on how to do the insurance accounting problems.